We have a lot to talk about for this Friday financial news. We need to talk about a jobs number that came in weak, why it was so off from the ADP report the day before. Is there something fishy going on with the data? We need to talk about a syndicator tied equities and why what is going on there will likely ripple through more folks. We need to talk about mortgage rates going to 7.22% and so much more. So let's get into it. This is your daily financial news for Friday, July 7th. Let's start with the BLS report, Bureau of Labor Statistics job reports, coming a day after the ADP report. Folks, if you don't remember, the ADP report was damn near 500,000. I think it was 497,000. It was a beat by over 100%. And really had some folks nervous for what the BLS was going to come out with. Again, the expectations were 240,000. Drum roll, please. We got 209,000. So a significant beat to the downside. Not only did we get a beat to the downside, we got a revision, a pretty significant revisions to past months, taking off over 100,000 jobs. So the job market, according to Bureau of Labor and Statistics, is slowing down, is weaker than expected. But what now shall we talk about ADP versus BLS? First, frankly, with all due respect to the team at ADP, there is only one job report that matters, and that is what came out on Friday, the BLS. ADP report is not a reflection of the entire economy. If you haven't heard it before, the ADP report is private payrolls only. The BLS report is the entire economy. What might be in the BLS report that is not in private payrolls? Government jobs. Now, if you go back and look at the surveys, which these are just surveys, there are collection issues or deltas. BLS, I believe, does weekly surveys and then puts those weekly surveys together into a big thing and extrapolates. ADP is a monthly survey. So again, some pretty significant deltas. If you are an OG at One Rental at a Time, you remember a year ago, we were talking about the ADP report being almost irrelevant. I believe there was a time where the ADP report was off like 9, 10, 11 months in a row. The team at ADP used to strive to be an early indicator for BLS. In fact, ADP, I don't know, process, math, whatever it was, algorithms, was so off, they stopped doing the report for, I think, 2 months. It might have been 3. The new ADP report, I don't know, process, I think has only been out for 3, possibly 4 months. So again, the ADP report, while interesting, it's just not important. There's only one number. The Fed will be looking at the BLS. The Fed will be looking at the collection of data. The Fed will be looking at, oh goodness, 209, lowest for a couple of years. We'll look at the revisions down 100,000, I think 109, and they will feel like things are going in the right direction. Now, CPI must come out and print really, really low for my expectation to be right. No Fed rate increase. I realize that sitting here this morning, I am 1 out of 20 experts. 95% or 19 out of 20 believe we are going higher. I just don't see it. I still don't see it, but we shall see. I will say this. I believe as of today, the Fed could pause for 12 to 18 months. It is my belief that if they push it, they try to get that 1 more, they try to get that 2 more, they will break something. All right, so that's the jobs number. The only number that matters is BLS. It was weak. It was weaker than inspection, revisions, all of that stuff. Now, let's get to tied equities, folks. And if you really want to read about some soap opera stuff that is coming to commercial real estate, I strongly recommend you follow Real Deal. They are a great follow on Instagram. I think it's The Real Deal. It might just be Real Deal. Anyways, they are a wonderful news outlet that puts out stuff about commercial real estate. And they did a great piece on Tide Equities, and they're naming names, man. I just love it when they name names. Tide Equities and 4 or 5 other private equity, or I'm sorry, syndicators. Tide Equities flew too close to the sun. 20% of their portfolio has already had capital calls. Their negative cash flow and declining occupancies as interest rates go higher. Tide Equities built a portfolio of $7 billion with floating rate loans. And if you've been on my channel for any length of time, you know I've been screaming from the hills, be careful, be careful, be careful. LPs are losing money like that deal in Houston, Texas, $100 million vanished. Now we have people like Tide Equities and many, many more asking for money. It is going to get bad. There were people that basically rushed into syndication, did some financial engineering, and didn't even operate the buildings, for heaven's sakes. This was what I was warning about. I was seeing deal flow, and this was total garbage. It was total garbage. And now, unfortunately, pain. We are seeing many syndicators' debt service shrink from 1.5 to 0.6. The pain is real. There will be forced sales. And unfortunately, a lot of this debt, this forced sales, this foreclosures, these short sales, whatever they will become, will not impact the syndicator, the GP. It will crush the LPs. Your equity is gone and you don't even know it. All righty, folks, let's talk about it. On Friday, mortgage rates went to 7.22. We are on path to, I think the high of last year was 7.37. It is wild to watch. If you saw my daily financial news from Sunday, July 11th, or July 9th, July 9th, you know I issued a challenge. How can you look at this as a good thing? We are going to find more motivated sellers. We're going to write offers below. We only do great deals. All of those normal one rental at a time things. So again, I want you to be positive. Rates going up is a good thing. Could rates get to 8? Frankly, they're there for investors already. Could they go to 9? Who knows? But let's write great offers given the debt structure and the cost of capital. If you have to write it below asking, who cares? Write it below asking. It's okay. It's okay. What else do we got going on? Levi Strauss came out with Friday earnings. They missed, or they slashed guidance, I should say. They slashed guidance, their profit guidance going forward. I think the earnings season will be very interesting this time. Let's talk about banks. I don't know if you know this, but this came from Lance Lambert, again from Twitter. Great follow. I don't know if you guys remember this, but do you remember Silicon Valley Bank blowing up? Silicon Valley Bank blew up when the 2-year note crossed 5%. They had what was called unrealized losses. Well, guess what? We did it again. We ticked past 5%. I think we settled just under it. But my point is, and this is something to watch, bank earnings are coming out very soon. Unrealized losses are going to go up. You're going to hear about hold to maturity and all of that stuff. But let's not forget, we've had a lull since March when Silicon Valley Bank and First Republic and Signature and whoever the other one was blew up. We're going to see unrealized losses go up. And we might see banks insolvent where their equity is less. That's not good. It will be interesting to see if unrealized losses force more acquisitions, bank runs. We've been here before. And when people see stress, they withdraw money from the banks. So will we see more bank runs? I don't know, but I'll be paying attention. Excuse me. What else do we got? I guess one more thing I read from Ramit Sethi, Getting Rich. Uh, kind of has 3 steps. I'll go through his 3 steps. Start investing and increase gradually. Push for your salary increase and pursue side hustles. Those are remits. My 3 are quite simple. Increase your discretionary income, become elite at something, and do it for 10 years. All right, folks, that is the daily financial news for Friday, July 7th. Like, subscribe, comment. We're about 2,500 away from 50,000. Please help us get there. Like, subscribe, comment. And if you like goodies, you can buy my course, How to Get Started One Rental at a Time, and get $100 in goodies. If you buy my mentoring at $7.99, you get $450 in goodies. How crazy is that? Take care, everyone. Thanks.